If you're a high earner in Washington, there's a good chance you're asking, could I be paying less in taxes? Now, the truth is that your tax bill isn't solely determined just by how much you earn. It's determined by the planning that you do before the year is over. And with Washington's tax landscape continuing to evolve, planning ahead has never been more important. Now, the biggest tax mistakes that I see are not caused by people intentionally doing the wrong things. They happen because people wait too long to plan or they weren't aware of certain strategies. So today I'll share 7 tax strategies that I think every Washington high earner should know. So starting with number 1, tax loss harvesting. Tax loss harvesting allows you to use losses in one part of your portfolio to offset taxable gains elsewhere. So suppose you sold an investment earlier in the year and realized a $150,000 long-term capital gain. You also own another investment that's currently worth $60,000 less than what you paid for it. If selling that investment, that one you lost money on, makes sense within your financial plan, you could realize that $60,000 loss and use it to offset some part of the gain that you had earlier. You would owe capital gains the $90,000 rather than the $150,000, which would have been subject due to the details of your other tax situation. After the sale, you can reinvest the proceeds so that your money stays invested. Now, one important limitation is that doing this, you generally cannot buy back the same security that you sold at a loss within 30 days, because that would trigger the wash sale rule and prevent you from using the loss. But you can purchase a different investment that provides similar market exposure if you want to stay invested even throughout that period of 30 days. Now, the benefit is that you reduce your taxable gain recognized today while keeping more of your money invested. For Washington investors, the loss may also reduce the amount subject to Washington's capital gains tax. Now, I think many people take advantage of tax loss harvesting. That's kind of like one of the first things you learn about when it comes to tax efficiency. But what about when you only have gains, which is a good problem to have? Well, that brings up strategy number 2, donate appreciated investments. If you already give to a charity each year, here's a strategy that I think far too many people overlook. Instead of donating cash, consider donating appreciated investments that you've held for more than a year. Now, this could include stocks, ETFs, or mutual funds, even cryptocurrencies. In many cases, you can avoid paying capital gains on the appreciation while also receiving a charitable deduction if you itemize. Let's look at an example. Let's say that you have an investment that went from $500 to $6,000. You have an unrealized gain of $5,500. And at a 15% capital gains rate, you would owe $825 in tax if you sold. Now, if you decide to donate some money to your local food bank, one way to do it is you could sell the $6,000 position, pay the $825 in tax, and donate the remaining $5,175 to the food bank. And then you could potentially claim the $5,175 as a deduction on your taxes. Or you could donate the stock directly to the food bank. Now, in this case, the shares go directly to the food bank. They sell the position immediately. They never have to recognize taxes because they're a charity. And they end up with more money, the full $6,000. You got to donate more to the food bank. You didn't pay the $825 in tax. And if you itemize at tax time, you get to claim the full $6,000 donation. The strategy is incredibly powerful for people who already are making charitable donations. For charitably inclined individuals that are selling a business, exercising stock options, or receiving a significant bonus, this strategy is even more important. Now, a bonus topic, if you have an ongoing charitable goal, you might want to look into what's called a donor advised fund, as these can also provide additional planning and flexibility when it comes to making your charitable donations. So moving on to strategy number 3, asset location. Most people spend all their time deciding what investments to own. Not a bad strategy, but smart high net worth investors will also think about where those investments should be held. That's because different investment accounts receive different tax treatment. For example, tax efficient investments that are long-term buy and hold positions, like index funds or ETFs, often make sense in taxable accounts. While investments that generate more taxable income, I should say, like bonds or REITs, or positions that may be traded more frequently, may benefit from being held within a tax advantaged account such as a traditional or a Roth IRA. You're not changing necessarily your overall investment allocation. You're simply organizing your investments in a way that may improve your after-tax returns over time. It's a small adjustment, but that can make a meaningful difference over years and decades. Well, we're on the topic of retirement accounts. Strategy number 4 is Roth conversions. There is no shortage of opinions on Roth conversions, and there have been many articles written on it. But it always boils down to one question. What is your tax rate today, and what do you anticipate your tax rate will be tomorrow? Now let's pause there for a sec. If you don't know what your marginal tax rate is, or what your average tax rate was last year, reach out to me and let me do some quick planning for you. This single piece of information drives so much of your tax planning. But I'd say that 3 out of 4 people who walk through my door can't tell me what their marginal rate is or what their average tax rate was last year. Shoot me a message and I can help you figure that out. Because when you do a Roth conversion, what you are really asking is, am I better off paying tax now or in the future? Now, this strategy can be especially valuable during years when your taxable income is temporarily lower than normal. So these types of periods might include early retirement, if you're between jobs, before RMDs, the required minimum distributions from your retirement accounts begin, or perhaps if you had a down year in your business. Rather than creating one large tax bill in the future, you may be able to spread that tax over several years while you're in a lower bracket. Plus, you benefit from tax-free compounded growth and the flexibility to take larger withdrawals in retirement without affecting tax rates or Medicare premiums. Now, let's get really Washington specific for the last 3 strategies. So strategy number 5, Washington capital gains tax planning. Just like in a Roth conversion, where you're trying to spread out your income tax recognition to keep you in that lower bracket, high net worth investors in Washington should be doing the same thing with their capital gains. Because over the threshold of $276,000 in capital gains, Washington adds a 7% tax, right? So if you recognize more than that exclusion amount, which in 2026 at least is $276,000 in capital gains, Washington starts tacking on an additional 7%. But with a little planning, you can often spread those big gain years out over 2 or 3 years and avoid this 7% tax entirely. Strategy number 6 is broad, but every high net worth investor should be taking the time to do Washington estate tax plan. Now, when we talk about tax efficiency, there's really 3 taxes that we're talking about: income tax, capital gains tax, and estate tax. Now, estate tax often gets ignored because it doesn't become an issue until you die. But when it does hit, it hits like a freight train. And from a lifetime tax burden standpoint, it's perhaps the most significant planning a person can do. Because Washington has its own estate tax, separate from federal estate tax, and its exclusion amount is considerably lower. For deaths occurring on or after July 1st, 2026, Washington's estate tax exclusion is $3 million. And that calculation may include more than your investment portfolio. It could include real estate, retirement accounts, business interests, life insurance, and other assets that may all contribute to the size of your estate. That means that families who do not consider themselves ultra wealthy may still be affected. Now, the good news is that starting early generally creates much more flexibility and ways to be efficient with this tax. Depending on your goals and circumstances, strategies may include lifetime gifting to your heirs, trust planning that preserves your spouse's estate tax exemption, life insurance strategies, or other wealth transfer techniques. The objective is also not simply to reduce your taxes. It's to preserve more of your wealth for the people and causes you care about, while making the transfer as smooth and intentional as possible. Now, estate planning is not something to postpone until retirement or later. The key is that the earlier you begin, the more options you typically have. So let's chat if you haven't started thinking about it yet. And finally, number 7, Washington residency and domicile planning. The final strategy here is especially important for anyone considering a major move or a significant liquidity event. Where you live can affect how certain capital gains are taxed, and the potential for additional taxes on higher earners has caused many affluent individuals in Washington to consider living elsewhere. Your domicile is essentially the place you consider your permanent home, the place you intend to return to and that you remain connected to. Now, that can matter when you sell intangible assets such as stocks, business interests, or cryptocurrencies. For example, if you are domiciled in Washington, when you sell a large stock position, that gain may be allocated to Washington state taxes and potentially subject to the state's capital gains tax. But simply buying a home in another state or spending part of the year somewhere else does not necessarily change your domicile. A genuine change usually involves establishing a permanent home and demonstrating that your connections and intentions have actually shifted to a new location. This is why residency planning needs to happen well before a major transaction. If you are already considering a move for personal or business reasons, the timing of that move relative to a large capital gain may have significant tax consequences. The key is that the domicile should never be treated as a last-minute tax maneuver. It's a facts and circumstances determination that should be carefully coordinated with your CPA and attorney before any major sale occurs. The best tax strategies usually happen before the end of the year when you still have choices. I'm Dr. Brock for Kimball Creek Partners, and until next time, make it meaningful.